risk now? Are you shooting for 2 to 1, 3 to 1? It definitely depends whether you're more of a swing trader and turning things over faster versus more of a position trader. But I'd love to hear your guys' thoughts with that, and maybe start with Mark Minervini.
Well, I mean, we're shooting for a minimum of 2 to 1. We'd like
Yep.
to have, the gains cover the losses by 2 to 1. And that gives you some room, to be wrong. 3 to 1 to 5 to 1 is, where I'd like to be on my better trades on the bigger winners. And sometimes you get 8 or 10 to 1, 8 or 10 or 12 hour trades. But on average, this is the thing that people have to understand. It's all about what happens on average. It doesn't matter what one individual trade does. It matters about what you do on average. When it all comes down to it, it's going to be your average gain divided by your average loss times your batting average. And that's it. That's the holy grail. Manage that, keep that a positive number, and you're a winner. The bigger that number is, the less trading you have to do. So if it's 1.1 to 1 and you're making $1.10 for every dollar you risk, you're going to have to do a lot of trades. You have to turn that over. If it's 3 to 1, you're not going to have to do a whole lot of trades, and you're going to be able to be wrong a lot more. So that's the balancing act that you play, and that is going to depend. If you're a day trader, you could have a 1.1 to 1 reward to risk, and you're going to turn that edge over. I mean, I have a couple friends that are day traders, very successful, and one of my friends, he does in one day sometimes 5,000 trades. I mean, can you even, it's almost unimaginable how that is possible with the amount of time that's in a day, but I've seen it with my own two eyes. Thousands of trades in one day. So think about that, turning that edge over, even if you're making, a dollar, $1.01 versus what you're risking. If you did it 5,000 times a day, that can add up.
And one thing that I've struggled with, especially, say you do it quarterly and looking back at a trade that was a few months ago, is it's a little bit tough. Of course, you can add an index to the chart, but it's a little tough to know the context surrounding that trade. Because we all know that if it's a semi trade and it starts pulling in, it's still above the moving averages, but all the other semis that are also maybe in your portfolio are pulling back in the same time, putting pressure on your equity curve, that type of thing. So my question is for you guys, how do you take into account the context of a trade to identify maybe those hidden mistakes that you're making, selling something too early, just because everything's pulling in when the chart is still not broken, and still, fine overall? And maybe I'll start with Brandon on this one.
Oh, you want to start with me on this? Okay.
Yeah.
Uh,
No,
yeah.
no pressure.
Yeah. Well, that's a tough question because listen, we always want to try to expand that average gain as well. So it's like you could be a strict 2 to 1 trader. That's fine, and your goal is to turn that over as much as possible. What Mark and I learned though is we got some really good stocks that we sold up 10% that we should have held for 20-30. Right. So it's like you gotta, again, this is going back to the post-trade analysis to understand how a stock fluctuates. Right. So if you get